All right, folks, we are back. Thank you for hanging out with me. Feels so good to be back home, back in the studio. Been a whirlwind of the past 24 hours, touching back down here in the Pacific Northwest. I almost didn't make it home. We touched back down to about 10 inches of snow here, and definitely enjoyed our time down in Scottsdale, Arizona. Just an absolute pleasure driving around there, taking a look at all the real estate down there. Wifey's family is from back there, so that's why we're there for 2 weeks, visiting friends, family, and soaking up all the sunshine that we could get. And we are back home, ready to get back to work, and I'm very excited to bring you guys this real estate update. And once again, just want to say thank you for all the support. I know the last 2 weeks of content on the road hadn't been the best, hadn't been the absolute fire content that you guys are always wanting to watch as far as production quality. But I continued to drop, videos on a daily basis while I was on quote unquote vacation, continuing to show up every single day just because this moment in time right now, guys, is so incredible. And so we're going to take advantage of it, not just on crypto. You guys know that we want to break down all of the current events, financial markets. And in this episode, we're specifically going to speak on the real estate asset class. So important because we got to have a roof over our head, right? Whether you're looking to rent, whether you're looking to become an owner, or whether you're looking to grow your investment portfolio, it's so important that we talk about this asset class. And in today's session, we are going to talk here about how the stock market finished off the week with an all-time high for the S&P 500. So stocks are at all-time high. Meanwhile, existing home sales actually fall to a level that we haven't seen in 29 years. So the stocks are pumping and the existing home sales are slumping, as we titled this episode. Going to get this one out, and we're going to be having ourselves a Discord weekly call this Saturday, always every Saturday, 8:30 a.m. Pacific, 11:30 Eastern. And so if you're looking to get tapped in with our community, that's over at my website, zachrector.com. But without further ado, I want to get right on into this update, guys. Let's get it going. So we start off here with this article from the Wall Street Journal. The S&P 500 climbs 1.2%, hitting a record. So after topping out in 2022 for the S&P 500, we had been really inching in here close on this one as we got the Santa rally. And we continue that rally into this new year, fueled by the chip stocks, the chip tech companies. Excuse me. The chip companies and the tech Magnificent Seven has been pumping the S&P 500, and it has now achieved an all-time high. Now, on the other side of this story, we got a bunch of good data points on real estate this week. And we started off here with the Builder Confidence Index jumping in January as mortgage rates fall. So builders are more optimistic about future sales for the first time since August, the National Association of Home Builders economist says. So this had been falling for the past few months. And for the first time since August, we've gotten optimistic and we've actually jumped in the builder confidence. The 30-year mortgage rate stayed well below 7%, which pushed the home builder index up 8 points. Okay. And this index is up for the second month in a row. Okay. And the January figure exceeded what economists were forecasting on Wall Street, was expecting sentiment to rise to 39. So a year ago, the index stood at 35. So, compared to last year, the builder confidence is there. And that's because rates have fallen off. And, I will say this. There's two parts to this as far as what I can read on the builders. The builders aren't just blindly like the stock market bulls that are just blindly, they got the blinders on. And the bulls just want to see this thing go up and up forever. Fundamentals be gone. Let's just pump it. The builders are in the real economy, and the builders got to move their product. And so the fact that they've had to add in all these incentives, all these products, they've tried not to do price cuts, but they've been offering a lot of rate buy downs. That's so that they can move their inventory. They are on the front lines. Now, new home sales is only a small portion of the overall sales in the real estate market, but it's a leading indicator, and it really does set the trend, and it really does set the market. And for the builders, I would be confident as well, as long as you can be flexible, you can pivot. You might have to change markets. You might have to change the product that you're building. But the United States continues to have a shortage of quality housing in quality neighborhoods. And with rates, ticking back down, I can see why their confidence is back up. But for me, I think that this temporary, rates coming down here slightly might have been a little bit premature. But nonetheless, we'll continue to watch it. The Fed, once again, has paused the last 3 meetings. I believe that next week we actually have another Fed meeting. I'm going to have to check on that. And we'll see what the next rate decision is going to be. But it's looking like they're going to have to keep it higher for longer. And this is what the broader markets are finally starting to realize. The markets had front run the Fed pivot, and it started to pump because everybody thought, okay, inflation has been killed. We've achieved a soft landing. We can start to have a good time again. That's what's taken the S&P 500 up to the top, a new record high. And, in regards to where rates have gone, that 10-year, we take a look at it right here, had fallen. It had topped out at about 5%. That was back in October. And it had fallen on all of this great news, this Santa rally. We've killed inflation. Inflation was ticking back down according to the CPI lie. And so the 10-year actually went all the way down here to about 3.78. Now, it has risen back up here slightly. And I believe that this is from the sentiment of folks realizing, oh, wait, maybe the Fed isn't going to cut rates so fast, right? And so we've seen the yield on the 10-year go back up to 4.12. We have not, I don't think that we've really seen mortgage rates tick up. Once again, they're still below 7% for the average. And this is after rates went all the way up to 8% for that brief moment in time back last year, towards the end of last year, when the 10-year had gone all the way up to 5%. Remember, that 10-year is the benchmark for where mortgage rates get set. So the Fed sets the Fed the Fed funds rate, which is what the rate that the Fed is lending money to the banks. And then the banks turn around and they add, right, their fee on top of that to us when they're giving us our mortgage. So this is what had taken rates up to 8%. Now they'd been falling off, and we got the rates back down below 7% for your mortgage. But it's going to be interesting to see what happens from here, right? If they kind of just flatline right here, because if the Fed just keeps this pause through the first half of this year, which is what's looking to be likely, right? Unless the bomb goes off, unless something crazy, black swan happens, which is what I'm kind of predicting, that's then going to be the catalyst for the Fed to cut rates, turn back on the money printer. But until then, the market has finally reached a point that's with inflation ticking back up. Remember, inflation on the CPI back up to 3.4% last week. So inflation is coming back. The strong, quote unquote, strong unemployment numbers, and then the jobless claims that just came in at, a very low pace. And that's because everybody's getting squeezed in the real economy. They're having to go get a second and third job. So the reasoning for a Fed to come in and cut isn't there. With inflation ticking back up, the economy remaining relatively strong, there's no ease coming in. And so we're going to have to watch and see where, that decision goes, because that's going to have the ripple effects into the real estate asset class. And effectively, the real estate reset's already underway. The chances of us going back down to the levels that we had, like I said, the nuke has to go off for us to go back down to 0%. So we'll continue to watch that one. And we got some more data points this week as well. Housing starts fall in December as builders scale back on single-family homes. So while their confidence is back up, they are scaling back on single-family homes, and housing starts fell to 1.46 million on an annualized rate. And if you look at what they did, they cut down on the single-family construction while they ticked up on the multifamily starts. Okay. So builders scaled back construction, new single-family homes, leading to an 8.6% drop, but ramped up apartment sales, which rose 7.5%. And that's apartment starts, my apologies. So less single-family homes, more apartments, and this is the trend right now for what the builders are getting going. And permits, it was the same story. So we got starts and we got permits. Permits for single-family homes rose 1.9% in December. Notably, permits for homes with 2 to 4 units, such as townhomes, rose 10.6%. Now, I'm seeing this in my area big time. A couple developments going in, but you guys are seeing this all over the place. The what we're doing is we're doing smaller units, we're stuffing them in, and a little bit more affordable product is being put out, right? And that's the focus right now. And I think, once again, that should lead to builder confidence, is that there's still so much demand that, okay, if we have to transition from single family to apartments or townhomes, if the builders are flexible, if they can make that work, there's still plenty of opportunity, in my opinion. Now, sorry, I'm recording this. It's 6 o'clock in the morning. I haven't even finished my first cup of coffee. So we're just first time back in the studio, first cup of coffee, getting rocking and rolling. Thank you for hanging out with me. This is the key data point, though, on this real estate reset, real estate data point that I wanted to share with you guys this morning, though. Stock market's pumping to all-time high. Meanwhile, home sales sink to a 29-year low in 2023. December home sales look to be the bottom before it inevitably turns higher in the new year, according to the chief economist at the National Association of Realtors. That is Lawrence Young, right? Now, what's key to look at right here? Home sales fell in December to the lowest level in more than a decade as demand continues to exceed the supply of listings for sale, pushing prices up to close out the year. Sales activity on a monthly basis was at the lowest level since August 2010. Sales of previously owned homes fell by 1% to an annual rate of 3.78 million in December. That's the number of homes that would be sold over an entire year if sales took place at the same rate in every month as in December. The numbers are seasonally adjusted. Okay. Now, compared with December of 2022, home sales are down by 6.2%. Looking a little bit deeper into this, overall sales dropped by nearly 19% from the previous year, falling to the lowest level since 1995. And the median home price reached a record high. So the price of homes has not fallen off too drastically quite yet, but the activity is dead. It is absolutely dead. I mean, okay, maybe it's not dead. It's on its last breath, right? The median price for an existing home in December rose by 4.4% to $382,000. But you have to understand, compared to the peak in June 2022 of $413,000, right? We've dropped down significantly. That's actually a drop of 7.5%. So for folks that want to say, broadly speaking, generally speaking across the board, the home prices haven't fallen. Okay, well, you got to take it market by market once again. But across the board, when you look at the median price of a resale home, it has fallen 7.5% on the national basis. Some markets, it's even more drastic. For new homes, we've already covered, it's about 17%. So new homes, those prices have come down depending on some markets. I was just in the Phoenix metro for 2 weeks looking at properties in Scottsdale, all throughout Phoenix, right? The last day that I was there, we drove all around Mesa, Gilbert, all through the southeast corner of the metro. And I mean, it's incredible how far out, you know, it reminded me of the Dallas-Fort Worth metro. These metros just continue to expand so big. It's incredible. I remember in Dallas-Fort Worth, you go up on a little hill, look over, and you, as far as the eye can see, you got new home developments, right? Same thing taking place down in Santan Valley, all the way out down there. And then when we went up into the northwest part of Phoenix Metro, out to Peoria, out to Prescott, those markets as well, Surprise, just same thing taking place. So on the outskirts of that metro, they're literally just throwing out thousands and thousands of homes as far as the eye can see. It was hard to get up on a hill to actually see that far because it's kind of just flat out there in the desert. But when you did, as far as the eye could see, new home construction, and I had to drive way the heck out there. I basically drove to the end of civilization, and I had to drive a long ways to get there because they are slamming in these, quite frankly, a lot of them are pretty nice. These huge master plan communities, thousands of homes with multiple different builders. And I'm going to show you guys, I'm going to do a separate Phoenix market update where I speak specifically on that market. But the whole time I was down there, I was snagging pictures and I was handing my phone to wifey so that she could snag pictures on the sides of the roads because there's all these signs on the sides of the roads from one of the largest home builders in the nation, Toll Brothers, the top of their signboard said special interest rates available. That's rate buy downs, right? That's how they're pushing product right now. That, special special rates, it was the top of their headline. And then all the other signs that I saw. And so the real estate reset is well underway across the nation, right? Existing home prices down 7.5%. In some markets, maybe you're actually still up. There are some markets that are still very hot with a lack of supply. That's the primary driver of why prices are still up, is a lack of supply and a lack of people willing to list. Now, what gets interesting though, and what most folks aren't accounting for, is if, they're saying that even if rates do come down some more, that we're not going to see a big influx of people listing because they're still going to be having the golden handcuffs, right? They're still going to have cheap rates. Why would you let go of your 3 or 4% rate, even if rates come back down to 5 or 6, right? What nobody accounts for is recession. And that's the big warning that I have for everyone, is that all of my data says that we're already in one. They've manipulated the data to say that we're not, but it's an upside down reality where, jobless claims are down, unemployment rate is down. Why? Because people are getting their second and third jobs. That's not a sign of a strong economy. That's a sign of a struggling middle class and poor. And we're all feeling it. Inflation's not gone away. And as we just saw, inflation tick back up. And what nobody accounts for is that, we're going to get a jobs recession, which we're already seeing massive layoffs. The other problem with markets like Phoenix, markets like Boise, Idaho, is that the migration that they were experiencing from, California and other markets, that's slowed down. And now people are returning back to the office too. And if you don't return back to the office, you're going to get laid off. So if you did move out to one of these metros and now you don't move back to the office, well, you're going to, you might still be in Phoenix, but you're not going to have your job, right? And so once again, you got to take this by a market basis, and leading that into the next article that I'm going to read. When you understand your market, you can understand what is the best move for you. So the next article that I'm going to show you is the comparison renting versus owning. And I want to say this before I get into it. Where you live, you don't need to own where you live necessarily to build wealth. Not at all. Not at all. And this is the white picket fence American dream myth, and a dream that has come to an end, really, when we really look at it. And so what I want to say is, even if you're someone like myself that's choosing to rent because I'm in one of these markets that is cheaper to rent than it is to buy, don't stop that from, don't stop that. Don't let that stop you from acquiring assets, whether that's building your real estate portfolio, whether that's, building up, a position in stocks, equities, cryptocurrencies, your business, whatever it may be. We want to own assets. That is where wealth is at, is owning and building assets. Now, with that being said, don't just throw money away. Don't force yourself into a bad situation just so that you can live the white picket fence American dream. And that's what we're talking about with this next data point, and why so many people are making this choice, is because renting a 3-bedroom home is cheaper than owning one in 90% of the United States, according to this most recent report. Now, there are markets where it is cheaper to own than rent, and that includes Riverside County, California, and Detroit. So there are some markets where you can still get in cheaper by owning. Okay, but we're going to have to continue to watch this, because for right now, in 90% of markets, and we're speaking on a 3-bedroom home, not an apartment, right? Not a little townhome. We're talking about a 3-bedroom home. I guess that would include townhomes too, where it's going to be cheaper to rent than it is going to be to buy. So let's continue to watch that one, folks. Once again, like I said, as someone who's in this position of renting right now, not going to let that stop me from building wealth. Not going to let that stop me from, checking out a market like Phoenix, where I'm looking at it for investment portfolio reasons, and the amount of businesses down there too. Massive opportunity, guys. This is a real estate reset underway. Massive dislocation and disruption and chaos within our economy as well. And this can be our opportunity if we are prepared for it. So all these data points reflect that a real estate reset is underway, but make sure you guys stay tuned, develop a plan for you, whether that's deciding to rent, whether that's deciding, hey, it's time to cash out the property that we have, we can move into renting for a little bit, and then we'll come back in and buy when it makes sense. Maybe it's time to start your real estate investment portfolio. If you want to do that, you can get tapped in with our private community, because this is what we're building out right now, is a community where we can look over deals and source deals for our community to build positions in real estate, build positions in private equity. And this is how our community is going to be building wealth outside of just holding our little XRP, right? We're going to be doing some other things as well, so that we're diversified amongst the asset classes, and we have a multifaceted strategy for building generational wealth. So with that being said, guys, I'm going to wrap up this session. If you appreciate the real estate update, we got some more coming for you, more content coming this weekend. So please make sure that you like this video, drop a comment down below. Let me know what you see in your market, and let me know what decision you are making right now. Are you deciding to rent? Are you looking to buy? What are you going to be doing for real estate investment? Let me know in the comments down below. I want your feedback. I read all of your comments, and I learn a lot from you guys. So please drop your comments down below. Let me know what you think. And all of our community resources can be found on my website, zachrector.com. Thank you so much, and God bless you all.